So in this session, I thought I'll start with the industry. Before we get into company-wise analysis, it is always a good idea to first understand the industry and what are the tools that we can use to understand the industry, whether you go bottom up or top down, whichever approach you choose, one way or the other, you have to understand the industry in which the company operates, right? So I wanted to cover three very important aspects about an industry. There are other some sort of ways and means also. For example, there is SWOT analysis and there is pestle analysis. But I thought these are the really crucial ones. We'll start with, for example, the industry life cycle first, and then move to the other two. So industry life cycle, basically what it does, it breaks down the industry into four phases. So we have the emergence phase, the growth phase, the maturity, and the decline phase. So any industry, for example, will go through these four phases, whether it's the e-commerce industry or the automobile industry or even the airline industry. Every industry is going through one of these four phases. So, just to quickly I'll just quickly cover these and then we take examples also. But so in the emergence phase, this phase is the very initial phase of the industry, right? So where the industry is in very early stages of development and has not yet been established. So when we say not yet has been established, as in there is no regulation from the government. It's the initial stages is all about innovation. So it's a new way of doing business, maybe a new product, maybe a new scientific development, whatever. But basically, innovation is driving a lot of the product development, and it could be a new solution or a service or whatever. And it is at the very early stages, and there is very limited rivalry. So very low competition, and hence there is high product differentiation because there's no copying that is happening. Right, there are very few Me Too players at this point of time, and these have fairly high growth potential. So that's this is the initial phase until this point of time, right? And then we get into the growth phase. Now, growth phase typically is characterized by rapid growth of the products and the services. It starts to grow very fast from year to year. So something like 20% plus CAGR or maybe more than that. So this is the phase where this industry is growing very, very fast. And here you will see new players coming in. This will be a fragmented market because a lot of players are now chipping in, a lot of Me Too businesses coming in after seeing the opportunity. And it's fast growth. This is followed by maturity, but between growth and maturity, there is something called as a shakeout. So what happens in shakeout is there is some bit of consolidation. So the smaller players get acquired by the larger players. They still continue to grow, but there's some sort of consolidation happening in the industry. And the growth rate sort of starts to slow down after that. So here, probably you will see the growth rate coming down to less than, let's say, 10% CAGR annually, right? Something like a paper industry, is representative of this growth, which means it has become very mature. And, on the other hand, e-commerce could be a growth story. Emergence may you can have your EVs, electric vehicles could be part of this story, right? So different businesses are at different phases of their industry life cycle. And then, post the maturity phase, then you start to see decline. Basically, that product or that solution is going out of fashion. This could be something like, your digital camera is going out of fashion and, phones taking over because more and more pictures are now being taken by phones, versus, let's say, digital cameras or proper cameras, right? So that's where we are. This phase, you will see a lot of consolidation happening. So, many players will exit and there will be huge competition. So typically, what happens in this is that there are few players left, right? After consolidation, after the shakeout and the maturity, there are very few players left in this industry, and these players will have one of these two characteristics. Either they will have a lot of product differentiation, which means, that is how they survive, or they will purely focus on cost. Whoever is the low cost provider will continue to serve the market. Any other player who is high on cost or something like that is going to be acquired by the larger. So that's how, this industry life cycle is from emergence to decline. We've seen this with a lot of products. Like I said, photography is one, which started with film photography, then moved to digital photography, and now we are seeing phones replace cameras in a big way. And we discuss some new examples. We look at the examples more, but I just want to cover, now that we're looking at these cycles, I also want to look at how the financial metrics evolve during this phase, right? So whether we're talking sales or cash flow or profits, how does that evolve as we go from launch to the decline, right? So in the emergence phase, which is the launch phase, here you will see first the sales coming, right? So typically, uh, you know, uh, sales comes first, then you start to see profits, and cash is even later, right? So this is the sequence. So for example, for a lot of these businesses like Paytm, what you're already seeing is that they are growing their sales very fast, but profitability is still elusive. They have still not achieved profitability, or maybe they are on the way to profitability, but this is something which is still not achieved. And that's because maybe they are in the growth phase right now, right? So at this point of time, at some point of time, see, that is, it depends on the business to business, but at some point of time within the growth phase, you have to start seeing your profits come, right? It can't be that that the business has already moved to maturity phase and you're still not profitable, in which case you will never be profitable, right? So in that context, we should evaluate some of these businesses like Ola, for example, Uber. you know can we call them businesses which are in the shakeout or the mature phase but still not profitable? In which case it's a very serious problem, because if you're not profitable in the growth phase or the shakeout or the maturity phase, then there is some issue with the industry. It's not an industry where you can invest, to be honest. But yeah, I think as long as you're getting from launch to growth. So for example, we're looking at some recycling businesses like Gravita India, you know Ganesha Ecosphere. These businesses have now turned profitable. They're growing fast as well as profitable, and at some point of time within the growth phase, you will start to see cash flows also coming, right? So that's when all your three matrices sort of are aligned: your sales growth, your profit, and your cash flows, right? At this point of time, most of people like us who sort of want our businesses to be profitable, this is where we, start to take interest in companies, and we take advantage of some of the growth and the shakeout, and then we try and stay invested till the maturity phase. Beyond the maturity phase, it's sort of the growth starts to slow down. So you're looking at less than 10% growth rate. So then these businesses become less attractive to us. But anything which is within this part of the life cycle is very attractive. People who are in the VC and the angel investing, they are more of this category. They like businesses within this category. We as public investors are more focused from here to here, right? Uh, and so this is how the typical sales, profit, and the cash cycle looks like, even as the life cycle matures. And if you look at the same thing from a funding point of view, so two things you can see very clearly. One is the business risk is going down as we mature, and you see the debt funding component increasing, and everything else is equity. So initially a large part of the investments is pure equity, right? We have very little debt. Because you don't have cash flows, nobody trusts whether you will survive, you won't survive. So your cash flows are not there, your profitability is not there, nobody wants to bet. No bank will give you loan. So majority of the initial funding is debt. But then as you start to get into the growth phase and you start to see more of these profits and cash flows come in, which is when banks are ready to lend you money. And then as the industry matures, you take more and more leverage, right? Because what happens is, margins are low. So if you have to really increase your ROCs, which is return on capital employed, you have to deploy some bit of debt to increase your returns, because the natural profits of the business starts to decline, right? And this you will see in a lot of mature businesses which are starting to decline, as in the growth rates have come down. They will start. The more stable businesses, the market shares of the players do not change much. There's very less innovation happening in those industries, so it's fairly stable. The banks are more comfortable with the cash flows coming in, and hence they sort of are ready to deploy more and more debt, right? So that's how the financial matrices change as we mature through the life cycle. And for every company that we evaluate, at some point of time, we have to look at this life cycle and decide where we are in the life cycle, right? And in that context, look at the cash and the profitability to say that, is there scope for us to make money here? Because sometimes when I look at these sectors like Ola and Uber, especially when I was looking at this, I thought this is quite a mature industry because there are no new players coming in, right? There's a lot of entry barriers around. Let's say if you want to start a cab company now, no VC player is going to fund you because there are enough barriers to entry right now. So, you know, as per my understanding, this is already sort of in the shakeout and the maturity phase. And if a business like this at the maturity phase is not profitable, then I could, I can in some ways confirm and conclude that this business will always remain a cash burning business all through its life. I may still be wrong, but this is how sort of I look at Ola and Uber. And one should look at e-commerce companies. For example, now you are starting to see some of these e-commerce players become profitable, although very slightly. So one can definitely conclude that e-com companies, for example, Nykaa, have really moved from the launch phase, which is the growth phase, to the which is the emergence phase to the growth phase, and they are now starting to see some profitability come in. It's a very small number, but the profitability is starting to show up, right? And that is a good thing because then we know that there is scope for this profitability to go up, the margins to expand as we go ahead, and there is growth and profitability together. Now, I'm not saying Nykaa is a good investment. One should look at the valuation before you take that call, but at least from a cycles point of view, there is growth, and along the growth there is profitability. So that's a good thing. And at some point of time, we should start to see the cash flows as well. Now, I've put in some examples. You can add some more of your own. So, for example, at this point of time, in the introduction or the emergence phase, we're starting to see more smart car come up, which is self-driving cars, electric vehicles, that sort of technology, starting to show up more and more on the roads. At least US, one could say that in US, this has already gone into the growth phase, whereas for in India, I would say it is still in the introduction phase. Whereas technologies like Wi-Fi, fairly acceptable, you'll find it almost in every other home. HD television, video conferencing through mobile, all of these are fast growing. So companies like Zoom and all can come within the growth phase. And then you have some industries which are quite mature. So you still laptops, cell phones, MP3 players. These are mature. There's not much innovation happening here. And the players are also more or less the same. There are no new players coming into this business right now. Yeah. And the growth rates have also moderated versus this segment where you could still see something businesses growing at 20% CAGR plus. And then there are declining where, desktop computers, maybe digital cameras, right? That sort of businesses, they are starting to see their revenues go down. And I'll talk about a very related concept here. So what is happening here is, as you go through this phase from uh, emergence to growth to maturity to decline, there is something called as value migration happening here. And it's a very important concept. We'll talk about it in the next slide. But essentially, it's not that we're not clicking photos anymore, but the way and the means and the ways of doing that has changed. And this product life cycle at least has come to an end. And there's a new product or a new innovation that is helping us take pictures now. Right. So I want to cover this concept as we sort of discuss the decline phase. And this concept called value migration has been, Adrian Slavotsky is the guy who sort of brought this concept, through his book. This is the book that he wrote, and it simply says that it's a defines value migration as a flow of economic and shareholder value away from obsolete business models to new, more effective designs that are better able to satisfy customers' most important priorities. And it reflects changing customer needs that will be satisfied by new competitive offerings, right? And this typically happens when there's a disconnect between the customer's priorities and existing business designs, right? So in some way or the other, for example, companies like, let me take Kodak as an example. These companies at some point of time, uh, they lost touch with their customers. There was this huge disconnect between what the customers wanted and what the existing business design was. And so they became irrelevant after a point of time, right? Not that they're not clicking pictures anymore, but it's just that Kodak is as a company is not in the frame right now, right? So I think it's very important as investors to understand these value migration themes, because we don't want to be stuck in a company from where there is value being migrating out of, right? So companies that are seeing the decline phase because maybe they're just too busy, you know, uh, stopping the decrease in their revenue. They're not seeing the big picture. They're just more focused on why the revenues are going down, and the management has no other solution but to keep obsessing about the problem. And they're not looking at the market. They're not looking at what innovation is happening. And at some point of time, I think Kodak did spend a lot of money in R&D, but at some point of time, they still did not think that cameras were out of the picture. So somewhere they lost touch, and we as investors need to be aware of these trends, because we cannot be invested in companies which are on the decline phase, or companies which are going through this particular phase called value outflow. So there are three phases, right? I mean, if you have to summarize, the inflow phase is called the emergence phase. The stage two is where you see the growth and the consolidation. And stage three is the decline phase, right? In a way. So we don't want to be part of the decline phase. We want to get out before we even enter the decline phase. This is our exit point. And once we've established that there is a new product offering, a new market, a new innovation, which is supposed to achieve scale and profitability. So I think two important words here. One is scale and one is profitability. So there are a lot of ideas in the market, but not all of them will achieve these two, right? But once you are sure that this business is scalable as well as profitable, and it is somewhere in the stage one or early part of stage two, that is when you want to start to invest, right? So this is a very important concept. We will cover why we see value migration happening, and you will relate to these concepts, for example. So so reasons why value migration happen, it can be because there is a new technology, some sort of innovation. It could also be because there is a low cost offering in the market, which is more cost efficient than the existing products out there. Third is because it is more convenient. So it provides value to clients or customers in terms of higher convenience to them. Uh, it is innovative for sure. Uh, it's something that the market has never seen before. For example, you could put iPads and iPhones in this category, and these businesses have access to funding. In some cases, we are seeing the migration happening just because there is access to funding. Uh, yeah, and because that thing can now be available for low cost because there is access to funding. Right now, we don't know if these businesses will be profitable, but there's certainly some sort of value migration happening here. Whether these are investable businesses or not, it's a very different question. And most likely, you will see in all of these situations there will be low switching cost. So it's very easy for the customer to just pick this option versus that option, right? And in some of these, you will see multiple factors. So it could be technology plus innovation plus cost plus convenience plus access to funding plus lower switching costs. I mean, the perfect value migration is one where you can find all of these six traits, right? And in some cases, you will find maybe just two of them or three of them. So look at some examples because, for example, in technology, in e-commerce, we are seeing two players come out, Amazon and Flipkart. It's a technology play in some sense. It's also a convenience play because it's delivered right to your doorstep at costs which are lower than the market, right? Something like a Netflix or Saregama, YouTube video, all of this is again technology where content is just placed in front of you at your whims and fancies. You can watch this content. So there's a lot of flexibility, again, convenience. It's cheap also, it's not expensive. Something like an Amazon subscription is cheaper than going to watch, uh, movies in a theater. It will probably cost you as much. Uh, so, and what Geo did with data, right? So basically, there was migration happening from calls to data, right? That's a significant shift that is happening. In with Netflix, we are seeing shift happening from people visiting cinema halls to now watching Netflix and Amazon Prime from their home. So that's a value migration that is happening. Uh, from cost point of view, I think two sectors which have already created a lot of wealth, IT and pharma, right? So this you can say is international migration, value migration. Value is migrating out of countries like US and now coming to India. Not now, but I mean, IT sector has seen value migration for more than 25, 30 years now. TCS and Infosys have been beneficiaries of this trend. Pharma, we've seen a lot of generic manufacturing coming to India, and even if you look at the large innovative pharma companies, they are now sort of deciding to get out of the generic business and get into the more innovation-led products, innovation-led drugs. And so all that migration and manufacturing is coming back to India again. So the pharma sector again has been a huge wealth generator. In airlines, we are seeing value migrating from, let's say, cars or road transport or rail transport to air transport. Now this I would think of it as in the growth phase, right? Because in India at least, a lot of people are yet to fly, and we are seeing more and more people fly. So this is obviously growing very fast. I'm not sure about the profitability of the industry, right? So we'll talk about that later, but we are seeing value migrate from roads and railways to airlines, uh, right? Banks we are seeing value migrate from PSUs uh, to private sector. In fact, I just put a tweet this afternoon about how much, what's the sort of value creation that has happened in private sector banks versus PSU banks. And this started in the year 1995 after RBI started allowing giving license to private banks. And I think HDFC and ICICI were the very first private banks to apply for that license. So we've seen this transition happening from PSU to private, right? Uh, the third and the fourth, sorry, is innovation. So we are seeing something like data migrate from on-prem data centers to cloud, right? Uh, so this is purely tech and innovation led, and companies like AWS, Google, Microsoft are benefiting from this trend. And this cloud migration trend is something that will keep continuing. Everything is going to go on the cloud. We are seeing electric vehicles replace internal combustion vehicles, solar replacing thermal. Now these are new technologies, uh, right? And that is sort of leading the value migration. Same access to funding is helping because we are seeing companies like Flipkart, Zomato, Swiggy, Ola, Uber. But these are new age companies which are now sort of providing more convenience. It is coming at a lower cost also, all because there is access to funding and lower switching costs. So very difficult, very easy to go to Flipkart and buy stuff online. Very easy to order food from Zomato and Swiggy while you are at home. Between Zomato and Swiggy, also there is no switching cost. It's just two apps which you can at the click of a button access. So again, very low switching costs between Ola and Uber also. I know there's something called as network effect, which has been discussed quite extensively, but I think at some point of time, network effect failed for these businesses, which is why they could never, I think, make the kind of money that initially investors thought they would, because network effect couldn't sort of help at least these businesses. It is also called platform play. So they were looking to do something called the platform play, which sort of didn't materialize. That's just my opinion. Now, I wanted to talk about some broad value migration themes which have really created a lot of wealth in India, right? And in, for example, value migration from public to private sector banks. So after RBI opened up and started giving licenses in 1995, since then, if you compare the combined market share of private sector banks, it has exceeded, it is now starting to exceed the combined market share of public sector banks. So in terms of market share, we are already there. In terms of profitability, private sector banks are much, much ahead of public sector banks, right? And this has created massive wealth for investors of private sector banks. And all of this migration has been because of customer convenience, right? We found private banks more responsive. Their technology was more up to date. They could do online banking, mobile banking, from home, and there was management which was quite committed, and it continued. So in a public sector bank, every 3-4 years the management would change, whereas in private sector banks, the management continued. Mr. Kotak and Parekh sir of HDFC, they've sort of stayed at the top, managing, doing the risk management, and being very prudent about whom they lend to, how much NPAs are comfortable, not comfortable. So they've created a lot of wealth that way. What we are now seeing very actively, and you will see that in terms of the current GST collection that you see month on month, right? It is clearly visible in the GST collection numbers. So there's a lot of shift from unorganized to organized. And the biggest reason why that is happening is because of implementation of GST. So a lot of companies, organizations that were not paying tax before, and because of which they were cheaper than the organized players, because of GST, that difference in pricing has come down significantly. And hence, in some ways, now the organized players and the unorganized players are almost at the same level in terms of competition. And because people can afford, they have better taste, they have increasing affordability. So now obviously they are starting to move to organized players. And because of that, again, the tax collection has started to go up, right? So this shift is already visible. There are some sectors that have seen a lot of benefit because of this. You can see the jewelry segment, the biggest beneficiary is Titan, right? So earlier, more than 90% of the jewelry segment was unorganized. The adhesive segment, at some point of time, more than 50 to 60% of the adhesive segment was unorganized. Biggest beneficiary of this has been a company called Pidilite, you would know. In electricals, a big segment, there was cheap electrical products being coming from China. Now that has gone, and we are seeing, companies like Havels and Crompton, right? These companies are doing very well now. They have created a lot of wealth. So, so this trend has really worked, and we've seen a lot of wealth creation. Again, one another value migration theme that has worked very well is cost, right? Which I discussed before. So IT sector and pharma, these two sectors have benefited significantly because of international value migration led by costs. Now we are seeing something like that with China plus one also. I mean, in a way, China is already a cheap source, cheap cost destination. But what the world is realizing is that now we have to have another destination because there are supply chain issues. So then India also becomes, a very good second best alternative to China uh, when it comes to value migration. So we might see some value migrate out of China to India. So that's a new trend that will start to pick up for the next decade, 2 decades. We are seeing solid proof of this happening, right? So it's not. I would still say this is in the emergence phase, and I can conclude that by saying that there's a lot of capex happening. So it's not just word. I mean, it's not just rumors, but actual capex being spent, which sort of confirms that this is an actual uh, trend that we are seeing in the market. Now, the question is how to detect value migration when it is happening, right? As investors, we want to understand and identify this as soon as possible for us to invest our money and then stay invested for the long term. So let's say, uh, you know, if you are able to identify good opportunities in the electricity vehicle side or the self-drive car side, or even in renewable, right? These are emerging areas. Now, can we, for that matter, recycling? Can we look at businesses which are at the early stage of value migration? Now, typically these are very subtle and difficult to understand. So, because I say this because, for example, Kodak management could not see this value migration coming through. I mean, at some point of time, they got surprised by how the market reacted because even they didn't sort of preconceive that this value migration is happening, or else they would have solved for it, right? In two-wheeler industry, for example, Aisher's Royal Enfield did not create any concern initially, as it was not a traditional competitor. So people thought it's a niche segment, maybe it won't become that popular. But for some reason, Ron Elfin went on to gather a significant market share and create a lot of wealth. So these trends, for example, take time to identify. Uh, but as soon as you identify, you sort of take advantage of that. It is better to confirm the trend rather than assume something. So look at a lot of data. So how can one basically confirm? So there are 4 ways you can do that. One, two, three, and four. One is you will start to see the market share moving, right? So at some point of time, you will see e-commerce retail, right, become a significant portion of the overall retail. That is when you know that this is a significant trend. So let's say if it starts to cross 5%, 10%, still in the growth phase, but starting to reach a significant minimum significant number, I should say, and after which where you can start to sort of look at this as a serious value migration trend. Second is that there will be some sort of innovation leadership. So it will be a new segment creator, for example. So iPhones, iPads, products like these, which are innovation. There's no other product there in the market which can resemble these kind of products. It will typically be associated with very high customer satisfaction scores. So people will like the product, they'll buy more and more of it, and that sort of flywheel starts to uh, rotate, which starts to benefit the industry. And at some point of time, the government will come out and say, you know what, these are the regulations, right? So, so if you look at what happened to the Bitcoin industry, uh, Bitcoins actually, uh, maybe I think 2015, 2016 is when they started to become serious. But the government came out with a regulation in 2021, quite late, after which, at this point of time, Bitcoin had already become very big. So, so typically, policy changes will come through, and that's when you know that it is starting to become big. That's when you know that this value migration is serious, right? So these are points to note when you start to see these significant things happening: market share movement, innovation leadership, policy changes, which is when you should start to look at these sectors in a more serious way and start to evaluate their profitability to decide on whether you want to invest or not. Uh, but I must clearly lay out that not all of these value migration trends are profitable, as you know already. Now look at, so that's value migration. I think when you start to I think the best way to invest in a value migration trend is to identify it as soon as possible. So can we, for example, look at recycling businesses, renewable businesses, electric vehicle businesses, battery businesses, uh, which can benefit over the next 10, 20 years, 30 years. It's like a decadal trend. We know it is going to happen. Uh, and then, stay invested with the most profitable player in that segment. And that will create a lot of wealth for you, right? It could grow your wealth at 20%, 25% CAGR as long as you stick to the right asset, and that can be a huge wealth creating exercise. So this value migration theme from that point of view is very powerful. If you can pick those themes well as an investor, and that's where you should do a maximum amount of reading also, right? As an investor, what is new that is happening? How can I pick the next new trend which is profitable and which will create a lot of wealth for me, right? So so that's where the industry life cycle and the value migration sort of go along. Uh, you know, um, Now let's look at Porter's five forces. I'm sure you would have heard of this frame, uh, you know, and maybe you would know, but in my view, this is like really helpful to identify uh, what are the competitive forces within the industry, whether it makes sense to invest or not to invest, right? And we'll take an example of airline industry to see whether it makes sense for us to invest or not invest, right? Uh, Typically, the best industry. So Porter says that there are five important forces that you need to look at. One is the threat of new entrants, which means how easy it is for new players to come and set up business, right? Uh, and if you are in a business which has high fixed cost, so let's say you need 1,000 crores of capital to set up this business, then it's very difficult to enter that business. If it has, let's say, barriers to exit, so for example, it's very difficult to exit the business also. So if a business is difficult to exit, people will not enter in the first place, or it needs specialized skills, or switching costs are very difficult. The cost advantage, there is economies of scale, let's say. So you will only become profitable when you start to do something like 1,000 crores of revenue. At this point of time, you will start to become profitable. And let's say to get here, you need 5 years of survival in the business. So these are things which make entry difficult. So people who are entering into this business, they will think 100 times before entering into this business. Only, let's say, the Reliance and the Ambanis and the Birlas and the Adanis of the world can have that sort of capital to get into this business, right? So the more difficult it is, the better it is for you as an investor, because then it reduces competition. The second is bargaining power of customers. So ideally, you would want the threat of new entrants to be low. So I am mentioning what is the ideal situation. Ideal situation, threat of new entrants has to be low. Bargaining power of customers, which means your customers should have the least buying power, bargaining power, right? So again, bargaining power of customers also have to be low, because you don't want your customers to keep dominating you. I mean, you basically, you should be in a position to dictate what you are offering. So, for example, uh, you know, in an iPad or typically that's what I've seen. Customers have very less bargaining power. I mean, the brand loyalty is such that whatever is offered to them, they just grab it. Uh, so I personally believe the bargaining power of customers there is low. Uh, these buyers are so 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 in which case it can be high. So for example, if your buyers are large and concentrated, so let's say you have only two customers, only five customers, in which case their bargaining power is much higher. Whereas let's say if you have 1,000 customers, so typically that's, if you analyze companies, they will say what is the concentration risk. That's because they don't want too much concentration within a small segment of customers, because then their bargaining power increases. So which is why we want the customers to be as granular as possible. See, even in case of banks, if you see, the retail book is the best book. It's not the corporate book which is the best. Retail book is very granular. There are low NPAs in that segment, so it's the best customer to have. So not all businesses are in a position to drive uh, what kind of customers they want, but if you are in a business where there is less concentration, you are selling to large number of customers, even if 4 or 5 of them go away, it doesn't matter. That sort of business you want to be in. Let's look at the rivalry. So obviously the competitive intensity also ideally has to be low. As an investor, I want very few players in that industry. I don't want new players coming in. I want, and the existing players also have to be less, so that I have enough market share, enough economies of scale, uh, and the switching costs are typically high. In a very competitive industry, the switching costs will be low, right? Uh, there will be very less product homogeneity. So, for example, you are selling cement, I am selling cement. There is no difference between your cement and my cement. Then the competitive rivalry will be high. But if for some reason I have differentiated my cement versus your cement, then the competition rivalry will come down. Right? So again, this is a very important element. If there are too many players, we as investors want to stay away from that segment.
What
Uh,
is this network effects, Ujjwal? I
See,
mean,
network is something which dominates. So, for example, I want to. So, let's say you are creating something called an exchange. Okay. So, exchange, let's say, is one place where people come and buy and sell. It's a market sort of thing. So, and in a city, let's say there is one market, there is market one, and uh, there's another market called market two, which is again a place where people come and buy and sell. It could be, whatever, groceries, vegetables, whatever. So, so what happens in network effect is when, so the more, let's say, buyers you have here, right? The more and more sellers will be encouraged to come and sell here, right? Because where there are more buyers, there will be more sellers. Where there are more sellers, there will be more buyers, right? Because uh, you know buyers know for sure that, yeah, I will get whatever I want here. Sellers know for sure that whatever I want to sell will get sold here. So this market becomes very efficient because of this network effect. So in a way, you are creating uh, this network of buyers and sellers uh, who come and sort of create a very efficient sort of exchange. What For example, Facebook is trying to do. These platforms are successful only because more and more people join here, because your friends are here, so I also have to be here. If I, let's say, start a new social platform, nobody's going to come here because their friends are not here. So if their friends are not here, then why would I go here? WhatsApp, again, I think at some point of time, there was an app called Telegram, for example, or even Signal. They wanted to, divert people from WhatsApp to Telegram and Signal, but that didn't sort of materialize because, see, ultimately, that all your family members are on WhatsApp. So if you have to message somebody, they are there, but they might not be on Telegram, they might not be on Signal. So that is the network effect. And then Facebook went and bought WhatsApp also. Facebook went and bought Instagram also. So what they are trying to do is basically, and now they are starting to connect Facebook with Insta, Facebook with WhatsApp. They are trying to create this network effect. So you cannot go out of this ecosystem. In no way is it possible now for you to escape the what is called the meta ecosystem, right? So that's network effect, because uh, majority of the people that you want to connect to are already on that platform, so you have no incentive to move to any other platform. If, let's say, you decide not to use WhatsApp today, you have to go and tell every other people you're connected to or want to talk to that please download Telegram app. Now how difficult it is that, right? That I'm not using WhatsApp. Now let's get to Telegram and you also download the app and then you will be able to talk to me. Right? That's very difficult to achieve. So that's where the network effect comes. So if you have more and more network effects, you've reduced the competitive rivalry in that industry, right? And so in this particular situation, market one will keep becoming more and more efficient, and market two will not be that efficient because a seller will say, why go here? I'm not sure if I'll sell my stuff. Let me go to this, right? So that's the reason. That's essentially what is network. Now, threat of substitute, basically, less the substitute products, more value for shareholders. So, for example, I was looking at this company called AGI Greenpack, right? AGI Greenpack manufactures glass bottles, right? Now they sell glass bottles to, let's say, Coca-Cola, right? Now Coca-Cola, so AGI Greenpack ka customer is Coca-Cola. Now Coca-Cola has alternatives. They may not just go with glass. They may go with steel cans also, aluminum cans, sorry. They can go with aluminum cans. They can go with plastic bottles, right? They can sell their beverages in any of the three options. AGI is just one of the options. Tomorrow, Coca-Cola can say, you know what, let's chuck glass bottles. Let's just do only cans and plastic bottles. In which case you can be easily substituted. So a company like AGI Greenpack will never be able to go and tell to Coke that, you know what, I'm going to increase my prices. Coke will come and say, no increasing price, or else I will switch to cans or bottles, or even to some other player who's providing me glass bottles, because ultimately glass bottles is a commodity, right? So that's where these businesses don't have pricing power. They can easily be substituted by Coca-Cola. Where the switching costs are low, Coca-Cola can switch. Where the substitutes have superior pricing. So, plastic bottles, for example, much cheaper than glass. Uh, Not sure what the match is for aluminum cans, but plastic bottles obviously much cheaper than glass, right? So there the substitutes have superior pricing, and they maybe have better attributes and performance characteristics. For example, cans are much, in my view, easier to transport. They will not break, whereas glass bottles will, right? So this is one case I can easily correlate to. So your product has to be unsubstitutable. In this case, you don't have substitutes. Either you will go to Instagram, either you will go to WhatsApp, either you go to Facebook. Whichever platform you are, ultimately you are connected to the meta ecosystem. So you are inescapable. Now your suppliers, their power on you also has to be low. So they should not be in a position to dictate you. In fact, you should be able to dictate them. And you should say, what, give me raw material on credit. So I will pay you after 45 days or 60 days or whatever, right? So you should be in a position to say that, what, raw material first and then paying later. Versus they coming and saying, no, what, you have to pay first and then I'll give you the raw material. So you don't want to invest in such businesses, right? So their bargaining power has to again be low, ideally, and it should be very easy for you to switch. For them, it should be difficult to switch. You should probably be purchasing raw material from not just two vendors but 10 vendors, so that you can create competition between them. So this is one way how Porter looks at suppliers, your customers, competition, the new entrants, and you can take a call whether the industry is good or not good basis these factors. Now, if a lot of these factors are unfavorable, then obviously that industry you shouldn't get into. But if, let's say, majority of these factors are favorable, then you should definitely get into investing in such industries. And I want to take the example of aviation industry. Now, I talk about aviation because this is within the growth phase, especially in India. Very recently, we saw a new player enter called Akasa. Now, it's a very dynamic world, a lot of players getting out, but there are new players coming in also. Right? So we saw Jet Airways. I mean, apparently they are again going to come back. So I can't say for sure. Uh, but yeah, uh, there have been players who've seen a lot of difficult days here. But we are seeing new players again coming in. Akasha is a new one. There's another one that I was seeing the other day. Um, and they're coming out with different strategies. Somebody's saying we'll do only tier two, we'll not get into the metros, we'll only do international, whatever. Right? But ultimately, if you look at the airline industry, it's the threat of entrant is ideally very low. I mean, it's very difficult to get into these businesses because first of all, huge capital investment, right? You have to buy aeroplanes, and each aeroplane is almost like 200 million. So there are lease contracts, long-term lease contracts. It's very difficult to get out of this business, and there is economies of scale required to be profitable. There is very strong competition, as you know. Today, you can go on make my trip, and every other airline is probably providing the same price for the same flight. There's no difference in pricing. In fact, they all want to be cheaper and cheaper and cheaper because they want to achieve economies of scale. For them, achieving a full utilization is also very important. You can't let up an airplane fly with just 50% capacity utilization. That again become unprofitable. So, it's a difficult game to manage the utilization as well as uh, the pricing. And I think that's where a lot of these pricing softwares are helpful. Um, Low cost of switching. So, you know, it's very easy for customers to switch. And regulatory wise, there's a lot of regulation. So in India, let's say if you want to start an airline industry, it'll probably take you more than 1 year to sort of just get started. Just the paperwork and the processes that you have to go through. So threat of entrant is really low in aviation industry, but we are still seeing new players coming in, right? That's because the opportunity size is so big. We are still in the growth phase of the business. We are not entered the maturity phase. So in the growth phase, you will see new players coming in. Now let's look at the bargaining power of buyers. So we as customers, retail, when we pick aeroplanes to fly, we are looking for low cost, right? Most of the time, we are looking for low cost, which is why these low cost carriers are so successful. Indigo, SpiceJet, all of them, they have gained market share. But there's a zero switching cost. I can go with this option, that option at the click of a button. I have no loyalty whatsoever. So there's a low switching cost, very low loyalty. On the other hand, they have to spend a lot of money making sure that the journey is very safe for every customer. Even if one person in the aircraft starts to cry about something, it becomes an issue for whatever reason. So they have to pay a lot of attention to the customers, but the customers literally have zero loyalty. And airlines definitely invest a lot on brand building, so it's additional marketing expense for them. So basically, bargaining power of buyers is very high. This works the other way for the industry. So wherever the bargaining power is high, it's not good for the industry. Rivalry among existing players, very high rivalry. So as you know, huge price competition. Facilities are standardized. So whether in Indigo or a SpiceJet or a Go Air, there's very little differentiation between the services. But somebody who can create a differentiation is a huge advantage, because I think that's how Indigo has been able to garner something like more than 40% market share, uh, and to be able to survive and grow this industry. But creating differentiation is very difficult, because ultimately it comes down to the same seating, the same food, more or less. And if you are relatively on time, then there's not much difference, and there's not much brand loyalty also. So rivalry is very high. You are in no position to charge a premium here. It's very difficult to charge a premium uh, in this segment. What I'm starting to see now is Vistara is starting to have some sort of brand loyalty. I'm not sure about it, but it seems like they are able to, generate some brand loyalty uh, within the existing space. And if that is the case, then obviously they will get benefits of that. The threat of substitutes is moderate, because there are, good options. Indian Railways, for example, other transportation means. But if it comes to time, then there is no other option. If it comes to, you want to do a same day, you want to reach to some place within India, then you have to take the, so from that point of view, I think the threat of substitutes is low to medium at max. Bargaining power of suppliers is quite high. There are only two big providers, Airbus and Boeing. So because there are just two providers, they can dictate their terms. So you have to, basically, it can so happen, for example, that you applied for a aircraft today and you'll get it next year maybe, because they are just so filled with orders, right? So in some cases you don't have any bargaining power. You just have to go by what they are saying. The other thing is, if your fleet is Airbus or Boeing or whatever, then you more or less have to stick to them, because the operations and the maintenance cost in maintaining two different types of fleets is also very high. So just from cost point of view, it is, once you get into one of these ecosystems, it's very difficult to switch. The switching cost is very, very high. So for them, these are fairly, oligopolistic businesses, you can call them. You would rather be an investor in these companies and be a proxy, go do a proxy play to the aviation industry, versus investing in an airline directly, right? That is how I would sort of summarize this thing. So yeah, I mean, in this session we talked about life cycles, we talked about value migration, and then porters forces. And I think if you combine all of these three thought process together to understand what business, what life cycle, profitability, cash flows, if you try and bring together all of these things, then you might come to a position where you can, uh, with some comfort, say that, what, this industry is looking good. It will grow fast. It is profitable. It is cash generating, and it has fairly good control over its suppliers, fairly good control over its customers. There is very low chance that a new entrant will come into the system and disrupt everything. So that sort of business is what we are looking at. These frameworks help you make up your mind and uh, convince yourself of whether the industry is attractive or not. We invested this company called Gravita India. It's a recycling business. Now it's a profitable, very fast growing business. Ganesha Ecosphere, again, they recycle plastic. Again, it's a very fast growing, profitable business. Now these businesses have 10-year, 15-year tailwinds. I mean, if you talk about recycling today, recycling is not even an industry right now. If I have to put it that way, it's not like a huge industry. But at some point of time, it will start to become a very big industry. Recycling itself, metals, plastic, you say it and it will be recycled. So yeah, I mean, so these sort of industries are now looking at decadal trends. I mean, next 20 years could be huge money making potential. So
So
one
that
way,
is not even in growth, right? So that is still
yeah, I would say emergence, somewhere between emergence and growth.
okay.
But obviously, I mean, these businesses are profitable. They are in the benefit of the society, and so a business like that, it's something like investing in IT 20 years ago, 30 years ago. So TCS and the Infosys of the world would have created so much money for you. So one way to invest is to pick some of these themes And what you should do, I mean, it's a sort of strategy that I would follow. Is, let's say if I'm looking at the recycling industry, I look at the who are the listed players. Let's say I have three, four listed players. Now let's look at the management. Let's look at the ROCs. Let's look at the ROEs and say, okay, you know what? This is the most profitable play. Now let me start putting money here. So what I'll do, I'll not put all my money in one go. Let's say if I have to invest 100 rupees, I'll put 10 rupees today, and I'll see the quarter on quarter execution, because I'm not investing for 1 month, 2 months, 1 year, 2 year. I'm investing for 10 years, 20 years. And I'll keep buying whenever this stock sees major correction. So, a COVID happens, or I don't know, 2008 financial crisis happens. Those are my entry points in a significant way. And in between also, I'll keep averaging whenever there's a, let's say, 10, 15, 20% correction. Uh, I'll just keep buying the stock as long as it keeps executing uh, over the long term. And at some point of time, you will realize that your position in this company is so big and so huge and it's so profitable, it'll start generating a lot of dividends for you as well. So, 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 people talk about decadal investing. I think this is one way. Value migration is one very good way of doing decadal investing, where you don't have to think about timing the markets. Every time the stock market crashes, it's basically an entry point for you. So you add in more, you take advantages of these situations to build your position in a highly profitable, fast growing business at a very decent valuation.